What's happening is what I call the everything code. If you've ever watched markets and wondered why prices move in ways that seem to defy logic, you're not alone. Take March 2023, when Bitcoin surged 28% even as several major banks were in crisis. It's easy to feel like there's an invisible hand moving everything against you. There is, but it's not a conspiracy. What's happening is what I call the everything code. This isn't a catchphrase you'll find in textbooks. It's a framework that connects four forces: debt, demographics, AI, and crypto into a system that shapes market patterns in ways most people miss. We'll unpack how soaring debt ratios, aging populations, AI breakthroughs, and crypto signals combine to move markets, even against the headlines. Understanding this code is the key to making sense of today's market surprises. Let's look at the market moment that exposed how these forces interact. March 2023 delivered a financial puzzle that caught most analysts off guard. As Silicon Valley Bank collapsed and regional banks came under pressure, tech stocks staged an unexpected surge. The Nasdaq climbed over 7% that month, even as bank failures and rising interest rates should have signaled broad market stress. On paper, higher rates typically hurt tech valuations, and banking turmoil usually drags the entire market down. Yet, the market moved in the opposite direction. What traditional analysis missed was the deeper system at work. Rising rates exposed bank vulnerabilities, but more importantly, they revealed how dependent the system had become on a set of interconnected forces. When SVB failed, institutional investors didn't retreat. They adapted. Industry data showed a clear tilt into tech stocks during the crisis, with notable rotation tracked by prime brokerages. These investors recognized that this was more than a banking crisis. It was a signal that the underlying structure of the market had shifted. Debt played a central role. As U.S. debt exceeded GDP, the Federal Reserve couldn't risk a broad credit crunch. They acted quickly, backstopping deposits and injecting $300 billion in liquidity within weeks. This was not just about stabilizing banks. It was about protecting the broader system from a cascade of defaults. Demographics added another layer. Over the past 2 decades, U.S. working-age population growth fell from 8% to just 1%. With fewer workers, the economy needs productivity growth to sustain itself. AI and tech stocks became the logical hedge. Nvidia's earnings, for example, jumped 26% year over year during the crisis, and institutions moved into these names as a solution to demographic stagnation.